Howdy. Welcome back to Dion Talk. There are a lot of people who own rentals who are trying to make decisions on, do I add more rentals? Are interest rates impacting me? What's going on with rents? And most of us are in this little box of where we invest. But there are some people that are operating at another level. So I watch things like Michael Zuber from One Rental at a Time, who gets up at 4 o'clock in the morning, reads a whole bunch of stuff that would put me back to sleep. And then he does a 15-minute update every day on the things that actually matter to an investor. So what I want to do today is I have Dana, the CEO of Hemlane, who's actually got a survey of, a much larger sample group than you or me, the property owner, who's thinking, this is what I'm seeing. So today we're going to go over this survey on what's going on in the market with rents and the things that are changing in the last few months, and some things that actually have me kind of excited about the next 2 years, more than the last 2 years. So Dana, can you tell me a little bit about this survey?
Yeah, thanks so much, Dion, for having me. So the first thing about the survey is this was really our initiative to really understand landlords and what they're going through across the nation from different backgrounds, different types of properties. We did multifamily all the way up to 20 units. About 56% were single family homes, where that's where the landlord invested. And what we wanted to understand was interest rates and inflation and all of these things that you hear about in the financial and macro scene, how that is impacting tenants, those who are living in the property, as well as how landlords are using the macroeconomics to think about their day-to-day. If we take a step back, a lot of these landlords and tenants don't understand it. Like with the tenants, if you said, oh, inflation is at 9%, they'd be like, well, what is inflation, right? So it was not really them understanding the macro climate, but looking year over year, hey, the cost of goods has, let's face it, gotten more expensive. How is that affecting you? Are you more cost burdened by rent? Have rental rates gone up with obviously the market increasing, rental rates increasing across the nation? How is that impacting you, et cetera? So we did a survey. We have 17,000 rentals. So we took this opportunity to do a survey and learn a little bit more here from landlords. Are they raising rents? And then obviously tenants, how that is impacting them as well.
Well, here's what I think is great about this massive flaw in the inflation rate. The powers that be have decided that they are going to use owner's equivalent rent when they're calculating inflation. Instead of going to landlords and getting a survey, people who actually are renting out properties, they go to homeowners and they say, how much do you think you could rent your house for? Like they haven't any idea what rents are or what they could be. So I'm excited to actually hear the data of what you found, because I was hearing that rents went up 4.5% when my tenants, and I have a small portfolio, it's only 16 rentals, but across my portfolio, the tenants asked for a 20 to 28% increase across the board. So that was the rent with a tenant's request for it to go up. I'm curious what's actually happening to rents, because the rent numbers quoted in inflation are not real.
Yeah, definitely. So first of all, 45% of landlords had said that they had increased rent by over 3%. So the traditional is between 1% to 3% is what you typically see. 45% said that they did increase it. So Dion, that is your world of increasing it more than that. One of the really, really interesting things about it was we asked why you increased rent by over 3%. And what's really interesting is, you could obviously expect, 50% of them were renewals, and they were like, great, we're renewing it. We're kind of moving it back up to market rate. Others were just turnovers. But one of the other ones that was really interesting was 28% of them said it was home improvements. They had said they were also doing home improvements for tenants and felt like that was also a reason that they could put it into there as increasing the rent. So it wasn't everyone saying it was just to get closer to market rate. Only 67% said it was to get to closer to market rate. There were other factors in there. And so the home improvements one was probably the most interesting to me. It means that a lot of landlords are looking at increasing the value of their properties. Always think that's a fantastic idea. So that was kind of one of the interesting takeaways. It was really split. Also for the ones who didn't raise it more than 3%, it was really interesting. 25% said that they didn't increase the rent at all on their tenants, and another 25% said that they had increased it between 1% to 3%. And those aren't the exact numbers, like 24.6, but just so the takeaway is there that you remember it. And Dion, what I think is really interesting about that is the 25% that didn't raise rents at all. That to me is a sign of, hey, these landlords are just happy, right, with the tenants that they have, but they also don't understand that 10 to 20 years down the road, that price might be really low, or expectations aren't set with the tenant that, hey, in the future, there might be an increase. So I'm curious to hear your thoughts about that, because you have the binder strategy. So curious to hear that when you hear that, a quarter of them didn't increase the rents at all.
So recently, Stephan released a video where he was selling off some of his real estate. Me and some friends did some videos talking about it. He actually responded, and he said, "You're right. One of the mistakes I made was never raising rents," which meant when he was comparing that asset class to his other ability to invest, the other asset classes looked like they had a better return because he had never raised rent in over 10 years. So if you have tenants that aren't keeping up with what your expenses are, what your yield is expected, what you have is a good landlord like Graham, who actually fixes things, takes care of things, has the financial capability of doing that, offloads the assets because they're not generating a good return. So now those properties are going to some other landlord who is guaranteed going to probably jack up the rent, because there's one factor that sets rents. There's a bunch of different opinions with different landlords, but there's one thing that's consistent. Area average rents set rents. Our expenses don't matter. If our expenses mattered in any way, a property that was paid off and a property that had a mortgage would rent for significantly different amounts. But that's not how it works. Tenants actually don't care what your expenses are. They look at, what would it cost me to rent a similar sized unit in the same area? That's what my rents could be. So there are people, I have a friend who has rentals and he's never raised the rents in decades. And I get it, but he has no money to actually take care of the properties. He's
property,
but his properties aren't being taken care of. So I think that's a mistake. You really do set the tenants up for a shock. Most of the properties I've purchased, I've preferred to have tenants in place. Usually landlords haven't raised the rents in a while. They haven't taken care of the properties. So when I purchase it, they expect to be kicked out. They expect for the rents to be jacked up. It's why the binder strategy works so well. I include them in the conversation. There's a factor that I think is missed with almost every news source that I've heard from so far on why rents are going up. When in 2020, for the first time in my life, we've had more ability to work remotely than ever. Homeschooling was more popular. So instead of having a $3,000 or $4,000 a month crappy little apartment in a city, you could buy a house for half that price or rent a house for half that price in an urban area. But people weren't sure how long they were going to be working remotely. Tesla came back and said, "Hey, return to the office or you go away," and they then get rid of 10% of their people. So people couldn't buy. So it increased demand on rentals, which meant area average rents went up. So landlords that weren't tracking that for the last 2 years, especially in a state where you have rent control, that maybe weren't maxing out the rents, are quickly going to fall behind. And then you're talking about an asset class I don't invest in, of the larger multifamily, 5 units or more, where NOI dictates whether the bank is going to continue your loan or not. Your ability to refinance or sell is based on that. I'm not saying be greedy, raise your rents as much as possible. And my binder strategy usually puts rents just below area average. So the tenants are still getting a good deal, but I'm actually making enough money to take care of the property.
Yeah, no, those are such strong points. And I think you're right. It really comes back to benefiting your tenants, right? To make sure expectations are set. There's not this emotional roller coaster of, now suddenly it's going to be much higher, and I never had expected that because I never had rents raised. Really making sure expectations are set and that you're running a professional shop. Dion, what are you seeing? Another question that we asked landlords we were really interested in is whether or not they were going to sell their rentals, and also whether they wanted to purchase more rental properties. What are your thoughts there, and what have you seen and heard about landlords and what they're thinking of, like, is now a good time to sell? The market's sort of leveling off at a peak price. What are you thinking and seeing?
A few months ago, it was a great time to sell. We had prices still skyrocketing, interest rates low enough for payments and yield to be high enough to have high demand where people could make over asking offers, waive contingencies, Interest rates have shifted, and what we're seeing now is that pendulum of fear of missing out switched from buyers who were waiving contingencies, offering to name their kid after the seller, to we don't have a buyer's market now where it's true. It is true. It's an actual story. They offered to name their kid after the seller, and they didn't win.
Whoa! Wow!
Because there was so much demand and so limited supply, and interest rates were still low. So now interest rates have impacted, and a lot of people misquote this. And it's bigger people like Graham Stephan, Meet Kevin, Richard Fain. They say this because it sounds catchy. And it's not wrong. It's just they misquote it. They say, if interest rates go up 1% or prices go down 10%, they're close. If interest rates go up 1%, buying power goes down. Not price. Price usually goes up when interest rates increase. Transactions will tank. In the 70s, we had interest rates almost double, prices almost triple. But we went to half the number of sales from the year before. So that's what we're seeing now is a massive crash in transactions. Less deals are happening. Median home price is actually going up because we're eliminating off the bottom end a lot. Investors I know that are willing to do the work, that understand the one thing that shifted in the market right now that does actually have me excited, are finding great deals. A lot are making the mistake of thinking, prices and interest rates are too high, so I'm just going to sit back and wait 6 months or a year, which is a huge mistake. But so here's the one thing that shifted in the market that has me excited. For the last 2 years, we've had no way to tell if we were buying a property that was somebody who just sold because the money was enough, or if somebody sold because they were a motivated seller and had to sell. Speed was your friend. You had to get an offer in 1 or 2 hours because the sellers didn't know the wave of offers that was going to come in. And if you can get in fast enough with a good offer, you could get it. What's shifted now is buyers have pulled back. Sellers were told prices are going up and interest rates changed to change buying power. So some people have been priced out of the market and can't buy. Some investors are priced out and can't find their yield. So sellers list their property, and instead of several offers coming in hours, days on market, that's the metric to watch. Days on market is increasing. So a seller that was expecting 10 offers the first day, that's sitting there for 5 or 10 days, like Michael Zuber from One Rental at a Time, his search now doesn't show him anything that hasn't been on the market for 30 days. In my area, I'm looking at 10 days. So if days on market are high, here's how you can tell if you found a motivated seller or not. If prices went up and somebody thought, I'm just going to sell my property because that's a lot of money, and they don't get their offer, they're going to take it down or just leave it on there. But if you, after that property's been on for more days than what was normal in your area, you can start making offers that ignore the list price. What amount makes sense to you? And I believe the buyer should be embarrassed by the amount they're offering. If somebody lists a house for $600,000, you should be offering $4 million. Once days on market has increased enough, they're probably not going to take your $4 million. The person who was just hoping for money is going to ignore you, maybe send you a mean email. The person who has to sell is probably going to counter with a number that does make sense. And we haven't been able to do that for over 2 years.
Yep. Yeah. No, I 100% agree. One of the interesting things that came from our survey is what you had mentioned of the decreased supply, right, on market. And we had asked these landlords, are you likely to sell, right? And what was really interesting is over 69% said that average of total landlords had said, no, I'm less likely to sell this year than last year. Right. I'm recognizing that prices are pulling back, so that inventory has gone down. What was even more interesting is that the longer you had been a landlord, the less likely you were to sell. And that's probably because, right, you have this asset where you're not, hopefully, I mean, none of our landlords, although I'm sure there's quite a few out there that have adjustable rate mortgages. But those who had been landlords for a long time said, no, I'm not going to sell. I'm going to keep this with these rental rates. And the less experienced landlords said they were more likely to sell. And when we asked why, they had said, oh, home appreciation, we're at a high, let's get out quickly, not realizing this buy and sell or buy and hold is a long-term game. And that, you want to stay in the market for a long time. You want to build up this portfolio. It was almost like they bought rental properties for this get rich quick. Now there's appreciation. Let me get out. And some did cite increased mortgage costs, which means increased mortgage rates. And that was why they wanted to sell, which means there's some out there that had adjustable rate mortgages may have purchased at a high and then suddenly are feeling that. And so I found that to be really interesting, that those landlords who have been there for a long time have probably seen this before and are just holding on to their assets and thinking with inflation and things like that, this is a fantastic time to have your money in real estate versus anything else.
Well, I'm with that 60+% who are in the no sell for a few reasons. In 2008, a lot of people will compare the crash in transactions that we're having now, or what they expect to happen, with 2008. And they forget that in 2007, we had over 50% adjustable rate mortgages. 2 years ago, we had 3%. Now we're at about 11. So it has ticked up some, but it's not 50%. We don't have ninja loans, no job, no income, no assets. We don't have people 105% leveraged. What we have right now, and one of the reasons why, so I've never sold a property. Someday I might.
But not today.
And the main reason I wouldn't sell now is the interest rate trap.
Yeah.
But no matter how long ago you bought your property, if you have a good investing sense, in 2020, you refinance to those record low interest rates. So either you bought in 2020, I purchased two. I purchased a fourplex in January and a triplex in November of 2020. Great interest rates. I'm trapped. And this is the buy and hold game, right? But buy and hold also includes selling an asset to 1031 the gains into the same type of asset. So that's still, in my mind, buying and holding. You're in the same asset class. That's very difficult to do when you're selling a property with a 3% interest rate and you're trying to buy a more expensive, because prices are higher, property at a 5 or 6% interest rate. It doesn't make sense. So less supply, but we're seeing less demand too. So I don't see prices coming down. And I had a video the other day where I did the math. We could see a 25% market crash next year, and prices are still higher than they were historically. And the largest market crash we've ever seen market wide in the United States was 8.9% in a 1 year period. So peak to trough, we've seen, 2008, 9, 10, 11 were more than that. But in a 1 year period, the largest drop was 8.9%. But next year, if it went down 25%, we're still up over normal, because historical average home appreciation is 4 to 5% for the last 60 years. 2020, we had in some markets 30% appreciation. We had an overall market average of 24%. So 24% for 2020 and 24% for 2021. We could drop 25% and we're still up more than 5% for each of those years. And a lot of people are calling for that crash, thinking that means that prices are down. No, prices are going to where they should be. And that's why we're seeing a lot of sellers not sell, because they were thinking prices are just going to keep going up. Well, as soon as that interest rate changed, buyers are disappearing.
Yeah, totally agree. Well, I want to finish this off by saying I think you're right that there's probably going to be some good deals on market, with a lot of people using this as an excuse not to look at the market, not to look at the prices, and think about things a different way. Interest rates, purchase price, all of this stuff is just one variable of the entire equation. And if you can play everything the right way and play your cards the right way, you might be able to get some great deals. So thanks so much. This was fantastic. I look forward to the next Dion Talk with you.
Awesome. Thank you so much.
Great. Thanks.
Until my next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.